Hello, Professor. My name is Arisra Huanwilai. I'm here today presenting Week 1 accounting in the headline activity. I selected the Tonight Show starring by Jimmy Fallon as an hypothetical case study for analyzing financial and accounting transactions. So, this is an example summary that Jimmy invited Kendall Jenner and Rob to be his gate in Flip Shot Show, which cost 200,000 and 22,000 respectively by paying half in advance and another half when they perform. At the end of the month, Jimmy received some of the money from the tickets sold and sponsor that he has an advertising on his show, as well as he had to pay utilities, electricities, and internet on February 3rd, 2026. So let's begin with the first example that Jimmy would pay half in advance and remaining half after the performance. So on January 1st, 2026, Jimmy made advance payment. So I would say since the performance had not happened yet, I record this as a prepaid expenses and crediting by cash. So this is kind of the company or Jimmy asset because he did not receive the services from Rob and Kendall yet. So on January 26th, once that we receive those services, those guys showing and they perform, we can record it as an audit expense with the full amount, and this is crediting by cash because this is the final 50% payment that we have to pay after they perform. And we delete this prepaid expense by crediting. And this is how it works. Like in the bottom line, it should be debiting or the expense by 420,000 and cash in the same amount. Because if you can see, we didn't debit cash. So cash remain the same amount of this. And the second example is Jimmy received revenue. So this is how it worked. On January 31st, we debiting cash for 585,000 and crediting revenue tickets sold by 60,000 and revenue sponsorship by 525,000. So the revenue basically increasing by credit and cash increasing by debit. This is how asset and revenue side works. For the third example, he had to pay the utilities, electricity, and internet. So this is basically expenses for January. And the way that we crediting accrue expense because this is not paid yet and we need to wait for the bill. And also we debiting utility, electricity, and internet recorded as incur expense in January to be paid in February. Once that we pay, we delete the accrued expense by 1,800 and crediting by cash. We paid and we just paid crediting by cash. That is how the asset work. As I say, asset decreasing by credit. And this accrue is such a liabilities because we use all the utilities, electricity, and then we paid later. So this is kind of liabilities things, and then we paid. So that's it. For accounting accuracy and corrections analysis on expense recognition. This is for the first example and the third example. So briefly providing case did not perform yet, which means expense is not occur. So we pay at once, then recorded prepaid expense, which is our assets. So and we receive services our case performed, then expense officially occur. As I say that ones that we recorded prepaid expense, that is because we didn't receive anything from the money we paid off yet. So this is our asset that we are waiting for the services or any, you know. And also when we receive those services, it is our expenses, obviously. And this is how accrue expense is recorded when received services. So basically, accrue expenses is liabilities because we are receiving those services already, but we didn't pay yet, and we have to, let's say, waiting for the bills, and we didn't pay at the end of the month, or we didn't pay on time. We paid next month. So this is how kind of utilities and electricity works. And this is analysis of revenue recognition. I would say it is recorded when goods are delivered or services are performed, not necessarily when cash is received, which means that once that we receive the cash from whoever, it is not the revenue yet because we didn't perform anything or we didn't get give them goods yet. And then once that we receive those stuff, we can record it. One that our client receive those stuff services, we can record it as a revenue because it's already performed, as I say in Kendall case. And in case the ticket sold for next month, it would be unearned revenue, which is liability. This is easy. We receive those money already, but we didn't provide anything for the customer yet. So we perceive that is an unearned revenue of the company. This is the references. So thank you for watching this video. If you have any feedback or suggestion or any recommendation, please provide me any feedback. Thank you so much.